dollarcollapse.com. Debt surge producing fake recovery. What do the following headlines have in common? U.S. wages grow at fastest pace since 2009. Euro area economy ended year with strongest growth since 2011. Surge in home prices is beating the one in mortgage rates. Manufacturing in U.S. expands at fastest pace in 2 years. And German inflation welcomed back. Well, I think the title already gave you the answer. Debt surge is producing fake recovery. Borrowing like drunken madmen sailors. And then it just trickling down into the economy. Oh, everything's fine. So would it make sense to spend $10,000 to get $100 back and lose the $10,000? Would that make any financial sense whatsoever? Spend $10,000, you get $100 back when you're done. That's it. What about the $10K? Oh, it's gone. And it's gone. Wouldn't make sense, would it? No. But when they borrow and issue all this debt, that's what they're doing. Massive amounts of debt, teeny tiny little trickle back. Here you go. So we can fluff up and show those great numbers we have. But what about the debt? It has to get paid. We got to make payments on that. Interest rates rise. The payments get massively higher. What about that? Let's not talk about that. Obviously, they're all favorable with the possible exception of German inflation, though even that is welcome. Taken together, they paint a picture of a global economy that's finally returning to the kind of solid growth and steady positive inflation that most people consider both normal and good. Unfortunately, the reason for the improvement is emphatically not good. In 2016, the world borrowed a huge amount of money and spent the proceeds. The result is growth, but not sustainable growth. Consider this. Federal debt in fiscal year 2016 jumped $1.4 trillion, or $12,036 per household. In fiscal 2016, which ended on Friday, which this is a while back, whatever, the federal debt increased $1.422 trillion, according to data released today by the U.S. Treasury. At the close of business on September 30th, 2015, the last day of fiscal 2015, the federal debt was $18.15 trillion, according to the U.S. Treasury. By the close of business on September 30th the next year, it had climbed to $19.5 trillion, or $1.4 trillion higher. So let's look at this little chart real fast. Just take one little quick look. This is from 1977, the year old Jay Snippy was born. And look how each and every single year we just keep going up and up. And look what happened after 2008 and so here's 2006, 7, 8. Big jump, big jump, big jump, big jump, little bit smaller jump, big jump, little bit smaller jump, and then a big jump. How does that say recovery? That's what I want to know. How does that amount of money say recovery? It doesn't and it can't. So again, my example, $10,000 to bring back $100. Great. It shows that we're in recovery. It shows the economy's growing. Run with it. Let's do it. You're better off giving people money. So if they upped at $1.4 trillion and that gives us $12,000 per household, 10 times that amount, 10 times 1.4 trillion is 14 trillion, which would mean 10 times 12,000 would be $120,000, but that's also at 14 trillion. We're at 20 trillion. So 20 trillion. I don't know the exact math on this, but it's going to be called 160 trillion or 1,000 or something like that, whatever. What would happen if you gave each family $160,000? You want to talk about a recovery? You want to talk about growth? Businesses would open. People would have ideas. It would just all of a sudden explode. Sure, some would fail. But when you give someone some money and say, okay, do this, do that, have some ideas, I got to get a loan. Oh, you're not qualified. You don't make enough money. Yeah, but I got a great idea that'll work. No, no. Go on the Shark Tank program, sir. Go on Shark Tank. You might make some money there. Maybe you can convince one of them. Yeah, okay. No, we got to give it to the banks. Forget you people. We're giving it to the banks. Our debt lords, overlords. So according to the Census Bureau's latest estimate, there were 118 million households in the U.S. So again, that's 12,000 per household. Corporates lead surge to record 6.6 trillion debt issuance. Global debt sales reached a record this year, led by companies gorging on cheap borrowing costs, i.e. near zero interest rates. The bond rally that dominated the first half of the year helped entice borrowers that issued debt via banks to take on just over 6.6 trillion, according to data provided by Dealogic, breaking, by the way, the previous annual record set in 2006. Companies accounted for more than half of the 6.62 trillion of debt issued, underlying the extent to which negative interest rate policies adopted by the European Central Bank and the Bank of Japan, as well as a cautious Federal Reserve, encouraged the corporate world to increase its leverage. Corporate bond sales climbed 8% year on year to 3.6 trillion, led by blockbuster 10 billion plus deals to finance large mergers and acquisitions. The remaining debt included sovereign bonds sold through bank syndication, U.S. and international agencies, mortgage-backed securities, oh, those things again, that's great, and covered bonds. The figures exclude sovereign debt sold at regular auction. Quote, the low cost of financing with record low interest rates simply made building up leverage tempting, said Scott Mather, Chief Investment Officer for Core Fixed Income at PIMCO. Total global debt tops 325% of GDP as government debt jumps. Let that sink in. Total global debt tops 325% of the world's GDP, gross domestic product, each year. So if gross domestic product, for this example, is 100%, global debt is 325%. How does one pay down 325% with 100%? Or if that was in dollars, it's the same thing. How does one pay down and pay off $325 with a $100 bill? You don't. Economies have to collapse. Dollars have to be crushed. Paper items, entities, so-called assets have to be destroyed. And you know the last thing standing usually, precious metals. Reuters says global debt levels rose to more than 325% of the world's gross domestic product last year as government debt rose sharply. Didn't just rise, rose sharply. A report from the Institute for International Finance showed on Wednesday. This institute report found that global debt had risen more than 11 trillion in the first 9 months of 2016 to more than a total of 217 trillion. The report also found that general government debt accounted for nearly half of the total increase. Emerging market debt rose substantially as government bond and syndicated loan issuance in 2016 grew to almost 3 times its 2015 level. China accounted for the lion's share of the new debt, providing 710 million of the total 855 billion in new issuance during the year, they reported. So to sum it up, he says emerging market borrowing in 2016 was triple the year earlier level. Let that sink in. Corporate borrowing was the highest since 2006, and the U.S. somehow managed to add another trillion of government debt in the late stages of a recovery, when tax revenues are usually strong enough to shrink or eliminate deficits. Since every penny of that new debt was presumably spent, it should come as no surprise that the latest batch of headline growth numbers have been impressive, which is the basic problem with debt-driven growth. The good stuff happens right away, while the bad stuff evolves over time in the form of higher interest costs that depress future growth, making it hard to figure out what caused it in the first place. What caused what in the first place? That's bad for regular people who have to live through the resulting slowdown or crisis, but it's fine for the people who made the borrowing decisions because they got credit for the growth pop but won't be around, having retired, with huge pensions and high prestige, before the secondary effects really kick in. This time, however, the cause and effect dynamic is being accelerated by a spiking dollar and rising interest rates, both of which raise the cost of debts that are denominated in dollars and or have to be refinanced in the year ahead. So the mother of all financial crises that has been inevitable for a couple of decades has, thanks to this new debt, taken a giant step towards imminent. And yes, we could argue this year, next year, the year after, the one after that. It's just one, as he said, imminent giant step forward. This is why I do these videos. People have got to understand what we are facing. Only thing left standing from the test of time history shows is precious metals. It's the only thing. You want to play with other stuff? Bitcoin? Hey, I understand. You want to invest in some stocks? Go ahead. But you should, rule number one, you should have precious metals physical in your possession, in your house, whatever, somewhere you can grab them first and foremost. And then once you meet your goals with what you wanted to acquire, then go play around. You want to play around with Bitcoin, you want to play around in the market, go ahead. Because if you lose that, whatever. You learned a lesson, right? Oh, I won't do that again. If you make some good money, you're not going to learn a lesson. You're going to say, damn, that was great. Next time I have an opportunity like that, I'm going to do it again. And then you might learn a lesson because the next time you're probably going to get crushed by the club. Unless you're just a lucky son of a gun. But anyways, again, Trump or no Trump, it does not matter. It apparently is not going to matter. Massive debt. And as I said, he wants to do some serious spending. Take care.